guys, welcome to episode 8 of Big Deal Real Estate. Today I want to go over what's considered the gold standard of real estate, and that's the capitalization rate, or cap rate for short. What it is it's usually expressed in the form of a percent that any investor or broker is going to use to determine the return that you're going to get out of an investment. So the equation you use to calculate it is cap rate equals your net operating income divided by the purchase price, or what the value of the asset is at that time. So for those of you who don't know what net operating income is, that's all the money that a property generated after paying all expenses including heat, insurance, the mortgage, the interest, everything. So for an example, if you wanted to calculate cap rate, let's say you wanted to buy a 4-unit apartment building in your hometown. You do all the numbers out and you find out that your net operating income for the year is going to be $40,000. And the purchase price for that 4-unit apartment building is $400,000. Do some simple math and you find out that you get a cap rate of 10%. To me, that's a good cap rate, guys, but it all depends on who you are as an investor. And here's why. So to give you a couple more examples, let's say you have option A. You have a single family house that you're looking into buying in your hometown, and it's in a great area, and it's getting a cap rate of 6%. We'll say option A, 6%, and it's in a good area, right? And then on the flip side, let's say you're looking into another single family house. We'll call this one option B, and it's getting a 10% cap rate, but it's in a not so good area in your hometown. You might be asking yourselves, well, Kyle, if that's the case and I'm ever in this situation, which one do I go with? Well, I'd have to tell you it all depends. It all depends on who you are as an investor, because if you're the type of investor that's looking for a more stable deal that doesn't have a whole lot of headaches and isn't going to cause you a lot of trouble, you're probably going to want to go with option A, where you can get a 6% cap rate and a good little return on it because it's a safer investment. But if you're an investor that can handle a little more risk and you want a little more upside to your investment, you're probably going to want to go with option B. So, like I said, it all depends on who you are as an investor. Me, I like to focus on anywhere like right in the middle. I like to focus on 6 to 8%. And I like to look for investment properties in nice neighborhoods to like mid-level neighborhoods. I don't like investing in poor neighborhoods. That's just me personally. But what I want to tell you guys though is, if you do find an investment property, it's a great single family house, it's a great apartment building in a great area in your hometown, and it's making 10, 12, 14% of a cap rate, I'm going to tell you guys to do that deal all day long. All I'm saying is I like to focus on 6 to 8%. If I ever find a deal that's doing 12, 14 above that percent on the cap rate, I'm probably going to invest. So just be aware of all that, guys. Another thing I want to go over is what cap rate doesn't go over is it doesn't go over certain market data, like macroeconomic data, like population growth and population decline. It doesn't factor those kind of things in. It doesn't factor in the debt amortization or debt pay down on the property, and it doesn't focus on appreciation of the property. So please be aware of that, guys. This is just one of the tools investors use to analyze a deal and find out if it's going to be a good deal for them. And I want you guys to keep this in your tool belt so you can use this in the future for when you start investing. Thanks for tuning in, guys. Don't forget to like, share, and subscribe for more content.